ครับก่อนที่ผมจะเริ่มพรีเซนต์นะครับผมพรีเซนต์ภาษาอังกฤษนะครับแต่ว่าก็อยากจะในฐานะตัวแทนของ Invesco ก็อยากจะขอขอบคุณบจ.บัวหลวงนะฮะแล้วก็ท่านผู้มีเกียรติทุกท่านนะครับอีกครั้งหนึ่งนะที่ได้โอกาสมาพรีเซนต์ให้ด้วยผมหวังว่าวันนี้เนี่ยก็สามารถที่จะแชร์ความคิดเห็นใหม่ๆนะฮะสำหรับทุกท่านแล้วก็สำหรับ 2024 นะครับโอเคก็หัวข้อของเรานะวันนี้ well let me switch first today so first the agenda really for me is really twofold right the first one is to give you a sense of our macro situation right now and the second really is to show a little bit more about the fund our Invesco Asia fund which as you all know of as BAsia right it's been a challenging year but the objective throughout this whole process really is to get the trust, right? Without all this trust that you guys have with us throughout all these situations and tough situations we have, we wouldn't have anything. So our promise to you really is to showcase not only what we think, right, about the markets themselves, but also why, and at the end, showing you about the results. Because at the end, that's why you've given us your valuable time, that's why you trust us with your money, and that's very, very important to us. So before we actually go on to anything, and I'll wait for the slides to actually come up before we actually go on. Right here. So this is actually, as you can see, is a slide of what we've been through. This is the MSCI Asia Pacific ex-Japan Index, which is, as you can see, for the past 30 years. It's the companies of all of you've invested in the past 30 years, what we've been through. Notes are very, very small, but you can see here going through quite a number of crises. Asian financial crisis, we had a dot-com bubble when we rise it back up, 9/11, there was SARS, global financial crisis themselves, right? So with this illustration here, what I want you all to do as you enjoy this right now, is to step back, take a deep breath, stay calm, right? Because year to date even, there's a lot of rich situations why people can actually going to freak out. But all in all, throughout this 30-year history, the second point I'm going to make is, if you actually invested back then, you made money, right? You made money. So we're also only at this one little blip here, which I'm sure me and my colleagues over here will actually share a little bit more about where the opportunities are. But I think that to actually level set, everyone needs to take that deep breath and calm down a little bit, all right, and look at the big picture. Now, I'll do one a little better and actually show you this chart right here. So the chart before I showed you was the MSCI Asia, ex-Japan. So that's actually the dark blue line that you see here. The light blue line is if you actually invested in our Asian equity fund. As I mentioned, number one, understanding about the markets, where the growth opportunities are. And second, what's important as well is making sure we deliver what we say we're going to deliver to you all. And at the end of the day, that's also about results. Right? At the end of the day, that is all just about results themselves. So if you actually invested throughout since 1998, you'll get around 5-point-something% in the MSCI index, whereas if in our fund, you'll get around 10. And we'll share a little bit more about why and how we're able to deliver that. Right? The index versus all. Trust, results, and then we'll go into the market deeply after that. So, market backdrop. I think Dr. Ming-Kwan already mentioned a lot of the different scary things that we all experienced this year, but what can we say? It was confusing, right? How would you summarize this year? Confusing, tough, scary, completely unexpected, right? So let's just run down a little bit of key items that happened. Well, Credit Suisse happened, right? Everyone remember that? The bedrock of the Swiss financial system that has been here for hundreds and hundreds of years, and within a couple of months, collapsed. Unexpected, right? China real estate, which we'll definitely go into a little bit. I know you guys have probably heard that on the news a little bit of China real estate and the sentiment. We'll go into China. But the sentiment of the China real estate still lingered, right? Fed rates. There's no way that you've looked at the newspaper and haven't heard anything about Fed rates and some opinion about people mentioned about higher for longer, right? Why is that? It continues to stay high. What impacts do we have for that? Inflation as well, right? It's getting better, right? They're trying to control that, and it's a very fortunate area, and we'll go into detail about that in Asia, where we're actually fortunate to have a very low inflation. But inflation in the US, I don't know, I'm not trying to do like a poll, raise of hands, but has anyone traveled over to the US or Europe lately and tried to look at the hotel prices? Or even, not just hotel prices, Starbucks, not including the tips that they're forced to make over there, but inflation is raging over there. What does that mean? It's just eating into the amount of consumer discretionary you're able to spend, right? Wars. And unfortunately, I have to say wars with a plural, with an S, because unfortunately with the Ukraine now, we also have a war in the Middle East raging right now. Now, I'm not trying to paint like a dull picture, but unfortunately, I'll stop, and that's what it is. But I'm just trying to say that through these years, any one of these situations could strike fear, and understandably, why it would make you want to go risk off and just go into deposits and not do anything at all. But I would remind you again, and so it's a different chart, and I'll show it again. If you can stay calm, you will continue to make money. And we see, and I urge you all to actually think about where is that growth. There's tons of amazing speakers and specialists here who can show you that, but really, where we believe has the most growth is here in APAC. And I'll show you a little bit why. So before I go into the portfolio itself, let me just stay on the macro backdrop that I mentioned a little bit and say that the starting points of Asian equities is also lower, right? And we actually, have a lot of tailwind going for us. This chart, and it actually shows really the fact that, Asian economies are recovering, right? So when I mentioned the fact that the Fed is actually going to, in the US, is super high, in APAC as well, and I'll show it later, is actually looking to cut. But this chart actually shows the fact that Asian companies are actually recovering post-COVID, whether it be through tourism, right? I think in Thailand, you guys are having these new policies, these visa-free for-profit policies coming back now. So the GDP breakdown itself is coming back up. The starting points of Asian equities are also lower, which is very, very important. There's a rising income and wealth coming up with the middle class, not just here in Thailand, but places like Indonesia, where there's a population of 300 million. So we have a lot of things doing well for us. And lastly, inflation. People talk about inflation in the US, right? Inflation in Asia, different kind of countries, are relatively mild. So we have that going for us. And it also gives us a lot of power for the monetary policies, the central banks themselves, of the different countries, to do something about it, to stimulate that economy, right? And we need both. So what are they actually doing? Well, if you actually look at this chart, it's actually about interest rates, right? Interest rates are extremely important, as you all know, because it does affect every single part of the economy. In the US, what they're doing right now, because of such high inflation they have, they're just trying to keep that under control. They need to do that. Here in Asia, because I mentioned that inflation is relatively slower and people don't have suffered in the past because of high inflation, the governments themselves had a lot more they're going to do. I'll keep it simple. The lower interest rates, the more they're able to stimulate the economy, the more money that can be going out there in the system to be put to good work, more lending that can be done for the small businesses, the business everything, from each particular. So what I mentioned here is the fact that Asian countries are in that late stages of this tightening, which means that going forward, they can start cutting, right, to actually stimulate the economy. And that's where we kind of see the forecast going on. Those are all great tailwinds, right, to actually help out with the Asian economies. But I think to actually start off with the big elephant in the room, as we mentioned, what we see this year with the reopening, it hasn't been that good for China, right? Let's be honest here. It's not the fact that China reopening didn't happen. It actually did. But it's disappointing because there are a lot of factors that even the analysts themselves a little bit missed, right? The growth prospects themselves. So let me highlight two major ones. One is really about the real estate debt overhang, right? So that's one of the reasons why, and we'll go into detail about how China has actually grown a lot, and what's big help with them is the real estate sector, right? But number one, they missed the overhang of how much the government did not come in and step in, and hence influencing and keeping that negative sentiment in the real estate sector. The second is really, there's a couple of reasons too, but there have been a lot of kind of cutting salaries in the financial sector, anti-corruption, but all this together really killed that sentiment and actually have the analysts to actually cut a lot of the growth forecasts themselves. Now, let's talk a little bit about the real estate sector, because I think that that's something that influences everything, because China does influence a lot of the different markets. What exactly happened? Well, in 2008 to 2016, there was one of the biggest credit booms that China had to actually drive. There were these policies to drive the growth of GDP, right? It was an unsustainable way of growing because it was financed through debt. Now, this party stopped in 2016, right, when they tried to control that a little bit. But the overhang still meant you can't just continue to stop. So what actually happened here? Let's go into detail a little bit. In the past, the local governments, right, would sell the lands to these property developers, right, these private property developers. They would take that, create, build, sell it to the consumers, kind of almost like the American dream, right? Everyone wants to own a house. People would lever up, buy these houses, right? And then, with our fast demographics, everything, everyone's getting wealthy. Sometimes they start selling these houses and even selling and buying and trading these houses as well, which is not a policy that the government wanted. You're not trying to sell these houses. Houses are for living, right? After that, the land prices, of course, goes up, of course, in the main cities themselves. Infrastructure, people get wealthier, they have more income, and that's one of the ways in which we say, well, there's a property-led cycle. Sounds good on paper, GDP goes up, they rose it up, but as I mentioned, very much unsustainable, right? Because it was all financed by debt. There are times when debt would come in, mature, so you have to pay, they would issue new debt to pay that back, right? Not the best model, but that's how the party put. Now that they're actually doing something about it, right? This is where we see, because in this little circle, this little property-led growth model, there are a lot of holes. And any one of these holes could actually burst that cycle. And that's actually what happened, right? Whether it be the 3 red lines, but people aren't buying, and that's why you see all these defaults coming in for these property managers. They're just cleaning that up, all this debt. The right thing to do, technically, but very, very painful for something to happen. Now, once they did this, well, as you mentioned, commons prosperity, right? This is very much not a capitalistic way of looking at things, of course, but we still think it is, China, of course. I'm not saying China, we're not bullish in China, but I want everyone to understand exactly why this sentiment still had that overhang. Now, hearing about this might paint a very gloomy picture, right? And people start thinking, well, I don't know, is China going to be, and there's a new term right now, it's Japanification, right? Which right now Japan has had amazing growth, so that's fantastic, right, that we're having so far. But if people who understand history, there are parts in time for 10, 20 years where Japan didn't really have that growth, right? So people are starting getting worried, right, about whether or not, well, is this going to be another Japanification, right, so that's happening in China? Because to be sure, the symptoms are pretty much similar. Plunging housing prices, right? And also unemployment with the youth, which is what we're seeing right now, too. Like I said, the symptoms very, very similar, but we actually don't think that's the true case. Back then, and I'll very much keep that short, in Japan, yes, there were plunging property prices. The prices of property went down on the asset side, but the liabilities stayed the same. What happened was the corporates themselves, the companies, delevered completely, right? They didn't want to borrow, they delevered, right? And so with that, they try to pay that money back. Deleveraging, no investment, no free reinvestment, and then you're stuck in this growth. We don't see that in China, right? From the real estate side, everyone's hearing about that. It's back on everyone's mind, but we actually don't think that's the problem, right? Because if you look at the balance sheets of these Chinese companies, most of them are actually doing very well. So I just want to make that clear, right? Because there's a new term with this worries about China. We don't see that happening, and we do believe, right, that China will pull out, will go forward stronger as well. Now, we do acknowledge the fact that as an investor, and I think we're in the investment community circle, right? We would like to see results, numbers, right? But let me just share a little bit on a personal experience as well, having educated in the States, having actually also lived in China for a couple of years, right? The mentality, very, very much different, right? So we're versus capitalistic society versus what the Chinese government are looking to do. So here's the argument. There's always two sides to the story, right? Here's the argument from the government or the Chinese government's perspective. Well, you're telling me that in U.S. inflation, you guys are having an inflation problem that you're trying to control. So you now have to jack up those interest rates just to combat that. My inflation's pretty low, so I'm doing pretty good, right? The second thing, well, is also about the property market themselves. Sorry. You told me in 2008, 2016 that there was a real bubble in the real estate price. I'm doing this right now. I'm controlling this right now. I'm containing this right now, right? Why are you complaining? My growth is at 5%, right? Name me another developed economy who can do that with that scale. So as you can see there, right, they're not really succumbing to the pressures for that per se. They're fixing it, and the ideology is very much different from growth at all cost to a balanced, harmonious society for common prosperity. And I think it's a very, very important concept for you to understand when you actually invest in China to keep those things in mind. Okay, so bullish in China. We still think they're trying to find a way, right? But it seems a very, very negative thing. So I'll have a little cartoon that we're trying to show you over here. That enough of the macro. I think that this year, if everyone didn't have, I don't know, NASDAQ, right? Or maybe not even NASDAQ, QQQ. It's 7 stocks within NASDAQ. Your portfolio, or maybe Bitcoin. Your portfolio at this point would kind of be like, it's okay, right? It's tough. This is why I urge you all, right, to the point, find out where the growth is. You believe in that growth. You stay invested. You stay diversified, okay? So with Asian equities, this is where we believe is the growth. Here's a couple of tailwinds for you. Number one, starting points of Asian equities is lower, and I'll show you why that's important in the next slide. Essentially, things are cheaper, right? The second thing is, I think everyone knows, rising income, rising wealth, demographics are good, right? Lastly, inflation is lower. I'm going to repeat these same 3 points again and again and again about why you should invest here. These are not tactical things. These are something that you guys can take it and go and look for the long term themselves. But I think to the point about diversification, what's important is if you know that the growth is in Asia, right, and you know that that's where the future is going to be, the important part, and I think this is pretty similar to Dr. Ming Kwan, right? I think she showed the different tabs or different blocks every year. That's timing. It's tough for you to time exactly who's going to be the winner, right? So for us, let's just look at this chart right here. In 2022, let's see who the winners are. I think Indonesia, Thailand did pretty well. India, losers, can't really see it. Taiwan, right? This year, Taiwan did pretty well, right? Korea, India. This is an ex-Japan thing, but I'm sure Japan did very well, right? So our point here is really the fact that if you're going to go and time the market and know exactly which country is doing well, then so be it. Please, don't invest in this fund, because it's very, very difficult for you to time that exactly right. Or we're just giving you the exposure to it. All right. The second thing here, and I know I'm going to get this question because this is the question I get more than anything, is like, Ken, should I buy now, right? Which I'm sure someone else is going to ask me. So when anyone asks me that, I just show them this slide. So let's just dig into this slide a little bit. On the x-axis is the price to book starting valuation of MSCI X Japan, which is really the price, the starting point of when you buy something. On the left-hand side, the more left you go, the cheaper it is. The more right, the more expensive it is. On the y-axis is the 5-year cumulative aggregate growth returns, so how much you can expect to make, right? Depending on when you come in, all right? Returns, depending on when you come in. Right now, we're in the pink line, right, as of September. So when everyone asks me, well, what can I expect technically? Should I get in now? It's like, well, if you're going in now, pretty good entry point, I would say. If you go a little bit less, you say you're going to wait for it to drop a little further. Yeah, you could potentially get around 13.2% annualized per year, but you never know. So here, I think if there's any one slide you can take from this about when to buy, this would be it. All right, very simple message also, but also very much powerful. The price that you buy makes a difference, all right? And if you need a little bit more proof to say, well, everything's relative, right? That's Asia. This is Asia relative to the world themselves. And as I mentioned, this chart just pretty much says that we're at a 17% discount relative to the world. So relatively cheap, as I mentioned, but also there's growth. So this is growth, the growth differential between Asia versus the US. And we actually see that going forward as well. So that's kind of where I want to be, being in an area where there is growth, relatively conservative inflation, right, where we can see a path going forward. Clearly, I'm bullish on Asia themselves, but having said that, I'll move on a little bit to talk about the fund itself. So just to keep it simple, I don't know if anyone's heard about this sign, buy low, sell high. Great point. Easy concept, very, very, very difficult to do, right? That's essentially the philosophy of our fund. Because difficulty lies in what's high for you all, what's low, how do we get in, how do we get out? The tough thing isn't even to lock in the profits and getting out. Once you have that profit, when do you get back in, right? That's actually the most difficult part. So to illustrate this philosophy within the fund that we have in BA Asia, a little bit more, let's just say, for something to conceptualize, this is it. So let me explain this a little bit more, and I think that there is every single position that we have within our portfolio, right? 50 to 60 stocks that we have. We already did, the team does an analysis of what price exactly is that fair value, right? There should be a line pretty much going over there, but essentially, the blue squiggly line is really the share price, as you know, that goes up and down daily, right? There are times when market overreacts. People become fearful. Things like news like wars, headline news, everything influences the prices themselves. And that's when we buy, because we know exactly what price is cheap, right? And we sell at a point where we think the fair value is reached, and we stop before we get too greedy. That's it. There's no other secret sauce, really. The secret sauce is just in it, and we've been doing this over and over again. To be fair, this is an extremely boring fund. It's a very boring fund. I don't know, there's not much really that you can do, but It's a very boring fund. There's a process they've been doing for 20 years, and it's a boring fund that works. So for us and for you all to understand the trends and everything, we just focus on the absolute results of getting you that fund and the process that works throughout the cycles. Doesn't matter which company, which sector, we can actually apply that process and do it right. Another way to look at it, and I think this should keep you guys awake a little bit, is we're stock pickers. We like to choose those positions that we put into the funds themselves and make sure that this is something that is like a gem, something that nobody else is looking. It's kind of like finding that little black sheep there. So how do we know that we found a good one? Well, that's really for people way smarter than me, who's our fund managers, who actually look at this day in and day out. But really, what we like to think of as ourselves is really a contrarian. So really essentially buying when people are fearful and selling when people are a little bit too greedy. Right? Let me just go through all this. So to summarize a little bit in regards to the fund itself, right? We target, really on every position that we have, an over 10% annualized return every year. That's number one, right? Over 10%. Second, we mentioned, is that we're valuation driven. That means knowing exactly what we need to buy for the price of the positions that we have, right? Outperforming over 3 to 5 years. Third, contrarian. So really the black sheep. We're trying to find that black sheep and make it a golden sheep. And lastly, we know that we have a good fund itself because once we find that, right, we make sure that the metrics, the balance sheet, and everything is very, very much healthy. And having a huge hunting ground within Asia with lots of growth, that's where we like to do, and that's where we like to hunt. I'll stop there real quick. And then I know that also we want to make sure we give you all a little bit flavor of how we're able to deliver that, and also where we're actually positioned right now. So right now, if you look at where we have within the fund itself, I'll remind everyone again to say that actually we are fundamental stock pickers. So, whether we're underweight, overweight, it depends on the position size that we have. So we don't care too much about this. But for the time being right now, we're overweight Indonesia, China, Hong Kong, and South Korea. Where we're underweight, Taiwan, and also India. Not to say that we don't like those markets, but it's really because we think that it's expensive. And we care a lot about the price. Right? The price we get in, I mentioned a lot about, we just care about the price. Right? We used to love it at all. So a couple of years ago, 2 years ago, we had a low, very, very low exposure into China, just because we didn't like those metrics. Nowadays, we believe that the investment risk reward is way better. Right? So we've been adding a lot into the portfolio itself. Liking sectors such as internet companies, life insurers, some auto parts. We actually in Q1 just added a consumer related stock, and also some wind turbine manufacturers at good value. Right? In Indonesia, we believe that it's actually a very, very resilient economy, and they also had a lot of impact and help from the commodity prices that went up, because Indonesia is very much commodity driven economy. And lastly, I mentioned about South Korea. I think it's just because of the governance. We've seen a lot of improvements as well with the governance within the companies themselves that gives us confidence to go in. What's also been very, very hot as well, as you guys know, would be semiconductors, right? And I think there's a shortage for that, so that's why we actually are in there as well. Now, underweight, I won't go into that much. I mentioned a little bit about some Indian stocks, but then that's only because of the valuation driven. We'll definitely go back in when we see the right price. This is a little bit about the sectors that we have here. As I mentioned, we're actually quite similar to the benchmark itself, where we actually see a little bit more of a trend, digitalization, especially in India. There's an increase in demand into insurance-related products. So we're actually overweight a lot of the insurance within Asia themselves. We added, as I mentioned, the consumer discretionary, which is one of the largest alcohol companies in China themselves. That's done very well. And then real estate. Where we've underweighted a little bit is in the IT sector because the price has really gone up a lot already. I won't go through a little bit of top 10, so I'm sure your relationship managers or people can help out as well. But the names such as JD.com, AIA, which is an insurance player, Alibaba, those are names that we would normally like. To summarize, I think it's really about areas that we like, which is really, I think, stock picking, technology, consumer, lending, autos, insurance, especially within the South Asian area. And the areas we don't like is really because of like I had mentioned, the prices. So to summarize of all this, right, I'll just go back to, as you all know, if you've seen this slide, which I started off with as well. I urge you all to first off ask yourself, where do you actually see the growth, right? Keep us accountable for it, to stay diversified, to stay invested, and most importantly, to stay calm. Thank you very much.